income statement, we've done the balance sheet, we've done the cash flow statement. So those are the things that I think they are key in terms of the annual financial statements. They all going to be part of the annual financial statements. If you will remember when I started the topic, I did say that all that we're doing for one set of financial statements. And I did say that in the financial statement, in the full set of financial statements, we're going to have what? We're going to have the income statement. We're going to have the balance sheet. We're going to have the cash flow statement. And then we're going to have notes to the financial statements. Note to the financial statements. And then I think this is the most important ones that we're going to have in the financial statements. However, this is not the only things that you will see in a set of financial statements. A set of financial statements does not only consist of an income statement, balance sheet, cash flow statement, and the notes only. We do have other things that are included there, and we have to know about those things. They are part of the financial statement. So when you're looking at a full set of annual financial statements, don't just expect that you will see the income statement, you will see the balance sheet, cash flow, and the notes. However, you will never find annual financial statements with no income statement, with no balance sheets. There's nothing there to report on. These are the most important ones. However, it's not like we only need them, no. A full set of annual financial statements will have these things that you can see here, but we've done all these things. Income statement, balance sheet, cash flow, we've done the notes to the financial statements, but we also have something called reporting, right? We also have something called reporting. So we need the reports from the corporate governance of the company. So what do I mean by saying the corporate governance? Those who are running the company, those who are leading the company, those who are governing the company, they must give us a report on the performance of the company for that particular financial year. If it's 2025 financial year, the leaders of the company or the management of the company or those who are governing the company, what must they do? They must provide us with a report supporting the financial statements that are included in there, supporting the income statement, explaining how did the company perform during the year, explaining the balance sheet position or the financial position of the company. Income statement gives us the financial performance, balance sheet gives us the financial position of the company, and then the cash flow movement of the company. They have to explain in a form of a report. So don't expect that when you see the cash flow statement, it's enough. When you see the balance sheet, it's enough. No, it will never be enough. We still need those reports from the directors of the company. We still need a report even to trust the financial statements. Once the financial statements are prepared, once they are prepared, that's good, it's fine. But us as users of financial statements, the outsiders of that company, the stakeholders of the company, we will never trust the financial statements. So we also need something called an audit report. So the reports that we need to have in the financial statements, we need a director's report, and we need what? External audit report, right? External audit report. So these are the two things that we're going to talk about today: director's report and the external audit report. These two, they should be part of the financial statements. It's very important that we have a director's report there. It's very important that we have the external audit report. Then that is going to give us confidence about the financial statements that have been prepared. We're going to believe that everything that is included there is valid, accurate, and it is complete. in those financial statements because I need accurate information that is supposed to be there. The income statement should be accurate. The balance sheet should be accurate. The cash flow should be accurate. That's why we're not allowing errors in accounting. We need to make sure that all the time we need to avoid errors. We need to limit errors. We need to put internal control measures to limit the errors that we can make in the financial and the accounting system. Okay. I want us to go straight to the, I want to show you first the financial statements, just an example of the financial statements that we have. If you look here, this is Clicks Group Limited annual financial statements for the 2024 financial year. In these financial statements, you're going to find income statement, yes, you're going to find the balance sheet, you're going to find the cash flow statement and the notes to the financial statement, even the accounting policies. There's something called accounting policies, but we don't have to worry about that at a grade 12 level. But on top of that, there are reports that we're going to find in the financial statement. There's a lot of them that we need to know. Here is a table of contents in the financial statements. It tells us about the things that are included in these financial statements. Let's just look at it. I'm just going to zoom it a little bit so that you can see what is included here. See, if you look here, there is a director's responsibility statement. That is page 2 of the financial statements. There is a certificate by the company secretary. There is director's responsibility. There is director's report. Can you see? We do have a director's report, which should form part of the financial statements. We have audit and risk commitment report, which is in page 4. We have independent auditor's report, right? And then after that, we start having what? The consolidated statement of comparative income. This is the income statement. Consolidated statement of financial position. This is what? This is a balance sheet. Consolidated statement of changes in equity. We should not be worrying about this one at a grade 12 level. This is here, the statement of changes in equity. It's actually the shareholders' equity, if I can say it like that, where there's ordinary share capital and there's retained income. We also have a statement where we're going to record those separately. Then consolidated statement of cash flows. This is the cash flow statement we spoke about. Then note to the consolidated statement of cash flows. We're going to have the notes and all of those things. Then we have note to the financial statements here. You can see that. Okay. These are the things you can see: company statement of financial position, company statement of changes in equity, company statement of cash flows, notes to the company statement of cash flows. You see, but most importantly is that we also have some reports, which is a director's report and then an independent auditor's report. Those are the reports that we need to understand. That's what we're going to talk about today. The integrated reporting, which will be part of your test, which will be part of your paper 1. Okay, let's go through it. Financial accounting of companies, analysis of published financial statements. You see, these are the published of financial statements now. These are the financial statements that have been published already, the AFS of Clicks Group, because they are available to us as a public. So which means now I can go and look at the financial statements and analyze them and decide whether I want to be part of Clicks Group or not. Okay, let's go and see. Introduction, things that they're talking about here. The analysis of the financial statements of a company explain the significant items, transactions, and events presented therein, right? Significant items presented in the financial statements, transactions that are presented in the financial statements, and then the events presented in. It is the analysis, which means now we need to analyze the financial statements that have been provided to us and then interpret those financial statements, which means now we need to understand what do they mean. We must be able to explain to those who have never done accounting to say, what is the meaning of these financial statements. This analysis also includes trends, conditions, and factors that influence the financial statements. The analysis of financial statements, therefore, explains the information contained in the financial statements. The analysis of the financial statements, therefore, explains the information contained in the financial statements. Everything that is included in there, it has to be explained. We have to analyze and be able to explain it, because sometimes numbers sitting in the AFS, they're not that meaningful in terms of understandability. From the external user's point of view, they might not understand. They might not understand what is included in those financial statements, and they may need an interpretation. Okay, look, how is that going to assist? This analysis will assist the management of the company in identifying any negative trends in the company's operation so that corrective measures could be implemented timelessly to remedy the situation. It's possible that the company can make a profit. Everything may look good in the financial statements, but the more we perform deep analysis, we may identify those issues. We may identify negative trends in the company's operations that may require immediate corrective measures. Otherwise, if we don't do that, we might find ourselves in trouble. So the management of the company, we also need that as part of the management. That is the reason why we analyze and we interpret the financial statement so that we can identify any issues that might have to be addressed. Okay, number 2, keep an eye on the cash flow requirements so that financial needs are identified timelessly. Cash flow is a big problem in each and every company, so it has to be monitored regularly. It has to be monitored regularly. Whoever who is running a business, they must make sure that the cash flow, they need to keep an eye on that. Okay, monitor important financial indicators in respect of liquidity, efficiency, profitability, and solvency. That is another reason why we analyze the financial statements, because it assists the management to monitor those important financial indicators, which can be liquidity. Can the company be able to meet its short-term obligations? That's part of liquidity. Efficiency, we're talking about what? How efficient the operations of the company are responding, profitability, and solvency. You cannot identify the liquidity of the company without analyzing the financial statements. You see now, Guti, you can prepare the financial statements and finish, but it doesn't end there. There's something beyond that we need. Right? Monitor the company's performance against the business financial plans. Right, against the objectives. Each and every company, it has its own objectives, it has its goals, predetermined objectives, what the company wants to achieve within the next 5 years. We have short-term objectives, long-term objectives, and we need to monitor the company's performance to check if are we going to meet our short-term goals and long-term goals based on the current operations. You'll never identify that information if you are unable to analyze the financial statements. Even you, if you tell yourself that you want to pass your grade 12 November exams with distinctions, if you want to get 7 distinctions in November, which means ufuna uphume ephepheni ngo-A 7, you have to monitor yourself now in March. You have to get those distinctions now in March exams. June exams, you maintain that, you get your distinctions there. September, you get your distinctions there. Definitely you're going to get them in November, but there will never be a miracle. If you're unable to monitor your progress during the year, you'll never make it in November. There will never be a miracle to say you're going to get 6 distinctions, but there's no time where you obtained them during the year. In March test, you didn't get any. June, you didn't get any. September, and then you're expecting to get it in December. No, you have to monitor the company's performance against the business's financial plans. If you are planning to get 7 distinctions in December, you must monitor yourself now. Get it now in March, get it in June, get it in September. Definitely in November, you'll get it. Same with the company. Same with the company. If we're planning to obtain a profit at the end of the financial year, we need to monitor that quarterly. Are we profitable in the first 3 months of the year? In the next 3 months, second 3 months of the year, are we still profitable? You see, then the company will be able to make that profit at the end of the year if we are monitoring the progress. The analysis therefore provides useful information to users of the financial statements for accountability and decision-making purposes. In analyzing the information contained in the financial statements, management is encouraged to make use of tables, graphs, and percentages to compare information so that meaningful conclusions may be drawn and interpreted. Obviously, when you're analyzing something, you have to compare with the previous years. So you need to prepare the graph for the current year, the graph for the previous year, so that you can look at the trend. If you have to do the line graph, you're looking at the trend, or you use the ratios, you use the percentages. If the revenue was 20% last year and this year it increased by 20% or 25%, then those are the things that you need to know. The percentages that will help you to see if we are improving or not. Even you, getting 50% in accounting, go match. It's okay. But in June, you must get 70 or 65. In September, you must get 80. Then in November, you'll get 85, 90, 100. You see, that is monitoring your progress. Now, we need to talk about the integrated reporting now, which is now the report that we have been talking about. We're going to talk about what? The integrated reporting. Okay, the King Code of Corporate Governance, which is King Report 3. Now, there's no longer King Report 3. That's something that you need to be aware of. There's now King Report 5. Recommends that companies produce integrated reports. What are those integrated reports that has to be produced by the companies? Those are the directors' report, and the integrated report includes all these reports that I have been talking about. Directors' report is there. External independent auditors' report is there. Okay. Number 2, companies that are listed in Johannesburg Stock Exchange, JSE, must produce integrated reports for their financial years starting on after 1 March 2010. Okay, that's not that important for now. I want to move on to this paragraph. Public companies have a wide range of stakeholders that have an interest in the activities of organization. A wide range of stakeholders that have an interest in the activities of the organization. Why we're saying that? If Shoprite is running there, we are interested in knowing how is the company operating. Me as a customer, a supplier of Shoprite is interested in knowing how is the company operating, because the interest is to know whether these people that are buying from us on credit, will they be able to pay us back that money? The banks or the lenders, they are interested in knowing how is Shoprite operating, because Shoprite borrows money from the banks and they will have to pay it back. The shareholders of the company, they are interested in knowing how is Shoprite performing, because we're expecting dividends. So there is a wide range of stakeholders. Who are those stakeholders? We talk about shareholders. We talk about suppliers, we talk about lenders, etc. Even the customers, they might be, they are part of stakeholders. Okay, they will require information on the organization's economic, environment, and social performance. Furthermore, as society's awareness on sustainability issues increases, for example, issues regarding climate change, so too has the importance of company reporting. This reporting can be referred to as sustainability reporting, non-financial reporting, corporate social responsibility reporting, triple bottom line reporting. They're very important. These are the reports that we're expecting to see in the financial statements. Because I told you about director's report and auditor's report, which is what we're going to focus on today. But those are not only the reports. There's sustainability reports, there's non-financial reporting, there's corporate social responsibility report, there's triple bottom line. What is corporate social responsibility? What do you understand about this? Corporate social responsibility. What do you know about this one? Do you know anything about the corporate social responsibility?
No.
You've never heard of it.
Maybe I have, but didn't pay attention to it.
Okay. Are you doing business study?
Yes, I am.
Okay, it's part of business study, what we're talking about now. It's part of business study. Corporate social responsibility. Each and every company that is operating, right, in our communities, wherever, in our towns, or wherever they're operating, we have Shoprites everywhere in South Africa. We have Shoprites wherever you are in Durban, there's Shoprites, Cape Town, there's Shoprites, Gauteng, there's Shoprites, wherever. Now, because the company is operating in our communities, or maybe is serving our communities, we go and buy Shoprite to support Shoprite, because what we're doing is helping them to generate cash. But this company has also a responsibility to bring back to the community. They must do corporate social responsibility. That's when the company brings back to the community. They come back to the community, bazosixhasa with something. It's either they go and then bayocasa with a soccer team, for example, they go and sponsor the school, right, with something. Maybe they buy shoes for Ringani, or they do something that will help the economy, the community. That is called corporate social responsibility, which means companies are taking their money and help. You remember it now, eh?
Yeah. But we just called it social responsibility, not corporate social responsibility. I just thought it was a different thing.
Yeah, but it's actually the corporate social responsibility. It is social responsibility, yes.
Angithi le mampahla le like like kula mampahla le ama-taxes and stuff, or then like some businesses are required to do something for the community and something like that.
Yes, they have to, especially companies that are registered in JSE. They have to do
Yeah,
something.
singekhumbuli.
Yes, that's it. Yeah, they are responsible because they're helping. They have to help the community, because not we help them and need to buy. Otherwise, without us, there's no Shoprite. There's no Shoprite without us. So they also have to bring back to the communities, whether they're donating something or whatever. But anything that is going to help, that is going to help. So those are reports, which means under corporate social responsibility reporting, the company must state there what did they do to help the community. I'm sure if we go on these financial statements, definitely we're going to find something about corporate social responsibility, a report on that. So I don't know where we're going to see, but if we carry on looking at this, we're definitely going to see something like that. Okay, but yeah, I'm not going to dwell too much on that. Let's carry on. Integrated reporting, therefore, integrates financial and sustainability information into one report. The aim is to provide a single report informing stakeholders how organizations impact on the environment and the community within which it operates, and how the environment and community impact on the business. Okay, so we integrating, the reason why we call it an integrated report, the reason why we call it an integrated reporting is because it includes everything like the income statement, balance sheet, also, and the other report, the sustainability report, corporate social responsibility reports. All these reports are combined in that one document, so that me, if I'm looking for information about a company, I'll get everything from that one report. It is called an integrated reporting because of that. Integrated report therefore gives stakeholders a holistic view of the organization by putting its financial performance and strategy in context to its relevant social environment and responsibilities. Since integrated reporting also includes forward-looking information, stakeholders are therefore able to make more informed assessment of the company, as well as how the company is dealing with sustainability and risk opportunities. Okay, I'm not interested in all these other things. Now let's talk about the independent auditor's report, because that's the one I wanted to talk about today. Director's report and the external audit report. So this is the one we're going to talk about for now. First, I'll start with this one. External audit report. We need to understand what is that, the different types of reports that we have. Have you done this thing with your teacher?
No.
You haven't done it, huh? Okay, no problem. No problem. But let's look at it and see. What is an independent auditor's report? Financial statements. For me to believe in these financial statements of Clicks, for me to trust these financial statements of Clicks, to believe in them, they must be audited. The financial statements has to be audited. The auditors must audit the financial statements. You see, these are the financial statements for 2024 financial year. Here is the audit report. Independent auditors report. What does this can give me confidence about the information that is included in these financial statements? Because what do? These people, they check the income statement. If all these amounts that are here, they are correct. Because you know, companies, what they can do, it's very possible that they can inflate these numbers. It's very possible that they can inflate these numbers. You can see here how much revenue Clicks made. And remember, revenue is like sales in the income statement. They made 48 billion, right? 609,808,000 rands. You see, 48,609,808,000 rands. That is the money they made. So because these financial statements have been audited, which means I can rely on this amount, I can believe that this amount is correct. This 48 billion is valid, is accurate, and is complete, which means everything that was supposed to be included there is included. Accuracy, we're talking about the correctness of the amount, the price times quantity. If they sold 1 million stock here, then it is one, because this value has been audited, which means it has been checked by the independent, the external auditors, because I do have a report here. I do have a report here, and the report starts from here. There is an opinion here. They even gave us the opinion. They even gave us the audit opinion here, of which that's what we're going to talk about now. Right, so that's what we're going to talk about, because look what they're saying here. Look what they're saying here. They're saying, in our opinion, the consolidated and separate financial statements presents fairly. You see, present fairly in all material respects the consolidated and separate financial position of Clicks Limited at 31 August 2024. Which means now, this is what we call an unqualified audit report. When they say present fairly in all material respects, that's what we're going to see now. That's what we're going to talk about now, the types of audit reports. Okay. Now, what is an independent auditor's report? Let's see. The Companies Act 71 of 2008 requires all public companies to appoint an independent external auditor upon its incorporation and each year at its annual general meeting. You see, it's not a choice for the company to be audited, but it is a requirement of the law, of the Act. Companies Act 71 of 2008 requires all public companies to appoint an independent external auditor. So which means now all the companies that has PTO, that has LTD, remember, private company is PTY LTD. PTY LTD, this is what? This is a private company. This is what? This is a private company. But what about LTD? LTD, this is a public company. So all the public companies that has their name ends with LTD, they must hire an independent external auditor every year at the annual general meeting so that they have their company, their financial statements being audited. Look, the auditor appointed must be registered and be acceptable to the audit committee of the company. You see, the auditor appointed must be registered and be acceptable to the audit committee of the company. The audit committee is responsible to oversee the external auditors, to check if the people that we've hired as our external auditors, are they registered with IRPA? What is IRPA? IRPA is an independent regulatory board of auditors, because for you to be an auditor, you have to be registered with IRPA. They can ask you that in a test. It's very much possible that they can ask you. It's very much possible that they can ask you. We have SAICA. SAICA, which is South African Institute of Chartered Accountant, right? South African Institute of Chartered Accountant, right? Chartered Accountant. Okay, then we have IRPA, Independent Regulatory Board of Auditors. Independent Regulatory Board of Auditors. Okay, so now for you to be an independent auditor, you must be registered with IRPA, so that we know that you are trained, you are an auditor by profession. And then if you want to be a chartered accountant, you must be registered with SAICA. Okay, so maybe somewhere they will tell us about this. Okay, so it is the audit committee's responsibility to check if the auditor appointed is registered with IRPA. Any firm appointed as auditors must specify the name of the individual member of the firm who will undertake an audit. The same individual may not serve as the auditor for more than 5 consecutive years. You see now, if let's say, for example, Shoprite is hiring me as their auditor, right? Which means I must have been registered with IRPA. Number 2, I cannot audit them for more than 5 years. No, 5 years is the maximum. So I can audit Shoprite in year 1, year 2, year 3, year 4, year 5. That is the last one. I cannot audit them beyond that. No. I cannot do that. Okay. So that is another thing that we should be careful of. Things that we should know. They can ask you this, maybe if there's anything where they're filling in one word, or they're saying match, maybe column A, column B, you must know that an auditor cannot serve as an auditor for more than 5 years. The Act also requires that the financial statements bear on the first page a prominent notice indicating whether the financial statements have been audited or not. On the first page, let's go and see if that is there. Let's go and see if clicks, if it's there. It doesn't state. It's just say annual financial statements. Nothing says audited. Nothing says audited. It just say annual financial statements. But that is not really a train smash because this thing, the report is there, right? The report is there. So it doesn't really, it's not really a big issue to say the financial statements, but financial statement, they should state there that audited annual financial statements on the first page, as it is stated there. Right? So, okay. 3.1, what is an independent auditor's report? Now you need to understand what is that report, because the report comes only after we have audited. We have performed an audit, which means what is, when you're auditing, that's when you're examining the financial statements of the client or of Shoprite. If I go and audit Shoprite, that's where I'm going to check their financial statements, the numbers that are sitting in the income statement. I'm checking if those numbers are correct, if those numbers have supporting documents to support. If we recorded 5 million and a certain expense is 5 million, if it's a rent expense, for example, I must check if there is a contract that supports that expense. Is it really an expense or not? Is it classified correctly? Is it recorded in the correct financial statement? I should not record something that should go in the balance sheet and I record it in the income statement. That is incorrect. So those are everything that I'm doing as an auditor. Checking if the numbers sitting in the financial statements, they are correct. And if they are not correct, then that will come from the audit report. We have to see that from the audit report. So what is an independent auditor's report? Let us see here. It is a formal opinion, right? It is a formal opinion. It is a formal opinion issued by an independent external auditor, right? Issued by an independent external audit as a result of an external audit, which is an evaluation performed on the financial record of the business entity. You see now, there must be an evaluation. When you evaluate, you're checking, you're examining, checking if everything is done right in the company. You're not just checking the numbers only, but checking the compliance with laws and regulations. Do they comply? If they're not complying, those are the things must come up on the audit report to show that there's something wrong with the company. To show that there is something wrong with the company. The audit report is generally addressed to the shareholders and serves as an assurance in order for the users of the financial information to make informed decisions based on the result of the audit. Why are we auditing? Is because we want to enhance the degree of confidence of the public. What do I mean by the degree of confidence? I want them to be comfortable. I want them to be happy about what is happening in the company. They must know the truth of what is happening in the company. So shareholders can rely on me as an auditor. Because remember, shareholders, they hire directors to run the company on their behalf. How are they going to trust these directors? Because these are independent individuals. Maybe they're not families, they're not friends. They just hired directors to come and run their business. So now for us to place trust on those directors, we can't just trust them, because other shareholders will find out that they know nothing about accounting. They just know nothing. So the reason for them to hire independent auditors is for the auditors to go and check the company, the operations of the company on the behalf of the shareholders. So they are helping shareholders and reporting to them to say, no, you should not worry. Everything is fine in the company. Everything is going well in the company. So there's no need for you to worry. There's no need for you to worry. That is the reason why external auditors have to perform the audit on those financial statements. Now, with type of audit reports, with types of audit reports, I just want us to talk about, we're just going to talk about the first one. We're just going to talk about the first one only, and then I'll leave it there. Unqualified audit report. What is an unqualified audit report? Number one, we need to know that the audit reports that we have, with unqualified audit report, we have a qualified audit report. Those two, they are different, right? With unqualified audit report, we have a qualified audit report. Then we have another one called an adverse audit report. We have another one called a disclaimer. Let me just type them here. Types of audit reports. Number one, we have, let me start with the unqualified, okay? We have unqualified audit reports. Number two, we have qualified audit reports. Number three, we have adverse audit opinion. And then we have a disclaimer of opinion. Okay, you need to understand all of these ones. You guys need to understand what is qualified, what is unqualified, what is adverse, what is disclaimer, because in a test, they can give you any of these. You must know how to separate what is the difference between all these so that you are able to identify that on the report, because you're going to have a report, auditor's report. It's just something, as you can see here, this is an independent auditor's report. They're just giving you a paragraph like this. So you must be able to tell what kind of report is this? Is this a qualified? Is this an unqualified audit report and all of that? This is what I showed you. This is what I showed you to say, you look at the opinion. You look at the opinion. Opinion is enough to tell you. Where it says in our opinion, that's where you start. Where it says in our opinion, that's where you start. That's where you will be able to identify whether this is a qualified or it's an unqualified. But you need to understand, what does a qualified report mean? What does unqualified mean? Let's look here. Unqualified opinion. This opinion is provided by auditor when he concludes that the financial statements gives a true and fair view in accordance with the financial reporting standards. So which means now unqualified audit opinion is the best, is the good one, but we call it unqualified. So when you're saying, when I say you don't qualify for something, it's like it's a bad thing because you don't qualify, which means we're excluding you, right? But you must know that's a good opinion in accounting. That is a best audit opinion, which means if the company gets an unqualified audit opinion, it means the things are going well in that company. As you can see here, it reflects that the financial statements gives a true and fair view. The auditor concludes that the financial statements gives a true and fair view in accordance with financial reporting. This type of report is given when the financial statements are free of material misstatements and are presented fairly, right, in accordance with GAAP, which means with the accounting requirements. This is the best type of report that a company can receive, and it is also referred to as a clean opinion. It is also referred to as a clean opinion. So it's a good one for the company. It's a good one, free of material misstatements and are presented fairly. Now let's go and look there. If you read here, you'll see that this opinion is associated with the unqualified. Look, they're saying, in our opinion, the consolidated and separate financial statements present fairly. You see, present fairly, which is something that is there. Free of material misstatement and are presented fairly. Can you see that? Can you see how is that become an unqualified audit opinion?
No.
You don't see it, eh? Are you still with me?
Yes, I'm with you.
Okay, listen what I'm saying here, right? What I'm saying is that an unqualified opinion, it means everything is going well in the company, right? Look what they're saying. Let's read the second sentence. Let's read the second sentence, right? I want us to read this one. If you read this one, they're saying, oh, let me just start this thing afresh, this paragraph. Unqualified audit opinion, right? They're saying this opinion is provided by the auditor when he concludes that the financial statements give a true and fair view in accordance with financial reporting standards. And then this type of report is given when the financial statements are free of material misstatements and are presented fairly in accordance with GAAP. This is the best type of report that a company can receive, and it is also referred to as a clean opinion. This is an unqualified opinion. Now, let us go to the financial statements of Clicks. Yes.
Unqualified opinion ile esayenziwa ama-auditors from within the business, angithi?
No. We're talking about external auditors here, not internal auditors. We're talking about external auditors. External auditors, they are not within the business. They're coming from outside. They are being hired.
So for it to be qualified, kumele benjani?
Sorry?
For it to be a qualified opinion, benze kanjani?
We'll get there. Don't worry. That is qualified. We will talk about qualified. But when we talk about unqualified, I'm saying everything is presented fairly. Can you see there? Everything is presented fairly. They say this type of report is given when the financial statements are free of material misstatements, which means there are no errors in those financial statements. And they are presented fairly. So which means they're reflecting the correct information that is complying with the requirements of GAAP. The GAAP principles that we spoke about, which is matching principle, prudence, you remember historical cost, you remember those things. They comply, these financial statements. That's why we give them an unqualified audit opinion. Now, I'm telling you that let's go to the auditor's report of Clicks, because this is the independent auditor's report to the shareholders of Clicks Group Limited. So which means the auditors came and audit Clicks, and then they gave us this report. That report, they're saying, you look here is the opinion, right? Is the opinion. But where you're going to see whether this is a qualified or unqualified audit report, this is where you need to start reading. Where it says, in our opinion, can you see? Because now they are giving you an opinion, right? In our opinion, the consolidated and separate financial statements present fairly. You see now, in all material respects, the consolidated and separate financial position of Clicks Group at 31 December 2024 and its consolidated and separate financial performance and consolidated and separate cash flows for the year ended in accordance with IFRS, okay, the accounting standards and all of that. But look, they're saying the consolidated and separate financial statements present fairly in all material respects, which now it comes here to say, if it present fairly, which means they are free from material misstatements and are presented fairly. So it means this is an unqualified audit report. That's what you can see here. Do you agree with me on that?
Yes.
So for it to be unqualified, it has to present fairly in all material respects. So which means now, when you're saying it present fairly, we're talking about the information that is sitting in the financial statements. What is in the income statement? What is in the balance sheet is correct. It presents fairly. There's no bias in those numbers, because remember, there's a risk that management may manipulate the numbers sitting in the financial statements. They can present numbers that are incorrect there. So when auditors come and check those numbers and they're saying those numbers present fairly, so which means the numbers are correct, they are comfortable with those numbers. So that is an unqualified audit opinion. That's what we're talking about here. But when we talk about the qualified, then now it is qualified audit opinion is something else now. We'll go deep with it. It's an opposite of this. If unqualified, everything is good. So for qualified, it's not good. It's an opposite, as you were asking. This opinion is issued when the auditor has encountered one of the following situations while performing an audit, right? We've encountered one of the following situations, which means there are problems with these ones. A deviation from GAAP. When you talk about a deviation from GAAP, which means it is a non-compliant with GAAP, which means the matching principle was not followed, historical cost was not followed, prudent, business entity, all those GAAP principles that you know. They're saying one or more areas of the financial statement do not conform to GAAP, which means are misstated, but do not affect the rest of the financial statements, which means they are issues, they are errors. For example, you see, but do not affect the rest of the financial statement from being fairly presented. For example, if the depreciation is calculated incorrectly, it's possible in the financial statement, maybe they identified that the depreciation was calculated incorrectly. Then the auditor will qualify the opinion by stating the depreciation misstatement in his report, but will issue a clear opinion on the rest of the financial statement. So it will be a qualified opinion because the auditor will indicate that I am not happy with the calculation of the depreciation. It is calculated incorrectly. Okay. So that's when the auditor would give a qualified opinion. If there's a deviation from GAAP, maybe they used the wrong depreciation method, or the percentage there. If the depreciation rate is 20% on a straight line, maybe they use 10% on a straight line, which is incorrect. If the depreciation is 15% on diminishing balance method, they're using 15% on the straight line method, which is incorrect. You see, but there's something wrong. When we give a qualified audit opinion, we're not happy with the financial statements. There's something wrong there. So we can't say everything is good. Everything is good only if we give unqualified opinion, everything is good. But when we give qualified opinion, there's something wrong there. I'll stop here for now. Any questions on your side, Simanga?
So it's mostly like notes or something, like it's theory.
Yeah, this one is theory. So we're going to deal with theory more.
Oh.
There's no numbers here. You can see here. I'll send this document. We have to go through it. There's no numbers. It's theory.
Then everything is fine.
Sorry? Come again?
No, it's like everything is fine. Yeah.
Okay. No problem. We will carry on when we meet on Wednesday to finish it, and then we can go and look at some questions for it. But it's